We're joined by Humphrey-Jenner. He's an Associate Professor of Finance at the University of New South Wales Business School. Good to have you back on the programme with us, Mark. Now, if President Trump follows through on his threat to target Iranian power plants and bridges by midnight, how much higher can we expect this war premium to push prices in the short term?
Well, certainly. Thanks for having me. And if President Trump were to follow through with this, well, it would signal that the conflict is not likely to be over, really in the imminent future. And that would, of course, push oil prices up. We already saw on the news that this peace deal was likely not going to occur. We already saw oil prices nudge up around $5 per barrel over the past 24 hours. Now, this suggests that oil prices could easily accelerate more, potentially toward the $150 per barrel area, if it really is the case that peace negotiations completely break down and then President Trump accelerates his push into Iran, potentially with further conflicts. And now, of course, it doesn't necessarily at this point, it's not assured that will occur, but absolutely would create a lot of volatility in financial markets. And given that about 20% of the world's oil supply had gone through the Strait of Hormuz, it would create a lot of instability in that, at least until countries are able to mitigate that and find other alternative ways of securing oil supply.
So what's the breakpoint for the global economy before we see a significant shift from market volatility to a full-blown global recession?
Well, certainly as oil prices accelerate upwards, we've got probably a couple of factors that are really going to permeate through. Firstly, we've got what could happen in terms of price setting. In particular, oil prices will reach a new domestic equilibrium in most countries. So to give you an example here, to make this more concrete, the real issue for economies with petrol prices or oil prices accelerating is particularly with things like diesel, which could particularly affect agriculture and transport and the like. Now, that might be mitigated if, in fact, diesel prices or oil prices more generally ratchet up and then consumer demand starts to go down through ordinary supply and demand, which would help to implicitly create a degree of rationing through price signals. What really becomes a little bit dangerous if a country starts subsidizing consumers' petrol or oil usage in order to offset the current cost of living issues that higher oil prices might drive, and that therefore would remove the price signal we really need to be operating here. If countries don't enable supply or don't enable demand, to taper back down, that could accelerate a further issue in the economies. Now, in terms of how rapidly we'd get there, it's going to depend a little bit on countries as well. For example, the United States is a net oil exporter, suggesting it is relatively better able to withstand this than other countries. Australia, by contrast, is not a net exporter, and indeed has about 39 days of oil supply, although it appears to be less for diesel, suggesting that Australia needs to find a solution to this if it is not going to have a particular catastrophe. And it appears to be trying to negotiate with regional players like Singapore, Japan, South Korea to secure more oil supply, but it really is going to come down to how they go about doing that. And many other countries are somewhere between those two levels of how a prolonged oil price increase would affect them.
Now, Iran is floating a proposal to tax ships passing through the strait even after the conflict ends. How is this being taken currently?
Yes, the proposal to have effectively a toll on the Strait of Hormuz is not exactly well received, but countries appear to be almost of the mind that they just want to get shipping through the Strait of Hormuz and therefore almost appear to be willing to acquiesce to it. Now, to be clear, it is not a good precedent. It kind of goes back to the Middle Ages times of robber barons creating effectively tolls or payments to just cross over bridges. Now, this is not exactly an ideal scenario where we set a precedent that countries are able to hold up waterways or hold up such things lest they get paid a toll. And in the case of the Strait of Hormuz, it's not as if it is like a canal that is being maintained. It is a body of water that would ordinarily have had a free flow of goods. And it begs the question as well of why is it that Iran gets the toll as opposed to the UAE or as opposed to myriad other countries that also about that area. So it is not well received, but many countries appear to be just somewhat relieved to get goods through the strait and almost willing to go along with it. Although the United States has signaled that it would push back, and President Trump has argued that the US might charge protection money to escort ships through the Strait of Hormuz, potentially ratcheted to the toll that would be otherwise imposed. So the US might itself be trying to get into some of that payment as well.
And what's the key trigger the markets are watching right now? Is it a ceasefire deal, a full reopening of the Hormuz, or is it something else entirely?
Well, at this point, any positive step would, of course, be positive news for the market. So even if there is a ceasefire deal that is temporary, that certainly would signal market relief because it would show a step in the right direction, potentially some relief in terms of oil prices as well. Now, we already saw markets actually nudge up a bit earlier this week, suggesting some optimism that a deal might be reached. Now, clearly, a full end to conflict and a full end to hostilities would be ideal. A full opening of the Strait of Hormuz would be ideal, but any step in the right direction would be positive news at this point.
And China and India have reportedly secured safe passage for their vessels. Does this fragmented shipping reality signal the end of uniform global maritime insurance standards?
Certainly it could. So at the moment, we've heard of China at least having more success getting ships through the Strait of Hormuz. There have been mixed reports since the beginning of the conflict about whether Chinese flagged ships would be able to get through relatively easily or not. At various points, Iran had turned back Chinese flagged ships, but it appears they are having at least a lot more success getting through than, say, well, particularly US flagged ships. Japan as well has reportedly made steps toward reaching an agreement with Iran. And if you've got countries piecemeal reaching agreements with Iran to try to get ships through the Strait of Hormuz, what it's going to need to lead to is the insurance step, which you've quite rightly alluded to. Because if you can't sail a ship through the Strait of Hormuz without insurance. And if, for example, Lloyd's and Western insurance companies are not willing to insure ships going through the strait, then it would raise the need for alternatives. So in the case of China, raise the need for alternatives based out of China, similarly with India, and potentially similarly with Japan. In essence, there would need to be an alternative to established insurance companies because you can't get a ship going without insurance.
We will have to leave it there for now. Mark Humphrey-Jenner in Sydney, thank you very much as always.